Get Rich Education is brought to you by Valhalla Wealth and Ridge Lending Group.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Hey, you're inside GRE, Get Rich Education, episode 178. I'm your host, Keith Weinhold, back to help you build wealth, back to detonate knowledge dynamite, and back to help you keep your daydream alive and to tell you why and how real estate has made more ordinary people wealthy than anything else. And importantly, it's without you having to be a landlord or flipper, just like it has done for me. You're going to find today interesting because I am on the hot seat as I'm being grilled by longtime Fox News anchor Clayton Morris. Now, where I'm interviewed here in a few minutes, you're going to hear some material that I've discussed on the show before, but also some things that you've never heard me discuss. But here, what's really interesting is just watch, just listen to how I present GRE wealth building principles to the media and listen to what their reaction is. Now, besides being a longtime Fox News anchor, the person interviewing me here, Clayton Morris, he's a savvy media commentator, so he knows how to ask a good question. But interestingly, he's also an active real estate investor himself. And when I talk about the 5 ways that real estate investors profit, just listen closely to his reaction here. I don't think he understood all the ways that real estate investors are paid until he learns about it from me right here in this interview. And if that's true, that's okay. We all learn sometime, but it's just going to be interesting for you to kind of listen for his reaction. I think especially when I discuss leverage and also the inflation profiting benefit that you get when you tie up long-term fixed interest rate debt. Most people don't know how real estate investors get paid. I can guarantee you that even if you've been investing in real estate for a while, you have friends that don't understand leverage. That is when you make a $20,000 down payment on a $100,000 property, meaning that you've borrowed $80K from the bank, that if you get 6% appreciation on the property, that the return on your $20K invested is 30%. And that 30% is one of just 5 ways that you're paid. So you surely have a friend that does not understand that you got a 30% return because you got a return on both your $20,000 down payment and you got the return from the $80K borrowed from the bank. That entire return is yours. A $6K return divided by your $20K of skin in the game, that's that 30%. Yes, you have friends that don't understand the power of other people's money. So listen to my latest media appearance here, and it might be interesting for you to gauge the reaction of the host when we add up the ROI. And by the way, I love educating people about real estate investing through the media. So if you know about a favorite business or investing show, tell them about me or even point them to this episode where they got to hear me appear on this show, and I'll try to come on to your favorite show as a guest. Here we go.
I'm super excited for my guest today. He's a contributing writer to Robert Kiyosaki's Rich Dad Advisor blog, and he just came out with his first book called 7 Money Myths That Are Killing Your Wealth Potential, which quickly became an Amazon bestseller. He used to toil as a soul-sucking workaday job for years kind of person, and then knew there had to be a better way than selling his time for money. And then he made his first ever home a 4-plex building where he lived in one unit, rented out the other 3. And today, guess what? He's financially free. He's a real estate investor for 15 years, and today he runs GetRichEducation.com, and he's the host of the very popular podcast, Get Rich Education. Keith Weinhold is my guest. Keith, welcome to the show.
Thanks so much for having me. It's great to be here.
Well, it's a real pleasure, and I love your philosophy, sort of wrapped around the idea of Robert Kiyosaki's, Rich Dad, Poor Dad education. So tell me, we're going to get into your story a little bit, but tell me, how did you come up with this idea that you knew that this was the mindset that you wanted to be in for the rest of your life?
Well, you know what, Clayton? And this is actually really good news for your audience, too. I started to realize that success, however you measure that in life, comes down to 2 words: be bold. Okay. If you can just be bold, you know what? You don't need to be the most intelligent person. You don't need to be the most articulate person. You don't need to start off as the wealthiest person. That stuff doesn't even matter at all. If you will just be bold, you can get what you want and you can impact the lives of others. So in being bold, I think maybe the first bold move I made coming of age is moving from Pennsylvania, where I've lived most of my life, to a place I vacationed and dreamed of living and moved, and that is to beautiful and pristine Anchorage, Alaska, where I live today. The second example of this is when it was kind of time for me to come of age and I was working my day job and you've got some liquidity and it's time to buy your first home, like you mentioned, rather than making my first home a single family home, I made it a four-plex building where I lived in one unit and rented out the other three. And that was actually something, this is very actionable for your audience, Clayton. You can still get in on an owner-occupied four-plex today with just a 3.5% down payment with an FHA loan. You need to live in one of the units for 12 months. And at last check, you only needed to have a minimum credit score of 580. So now you've got real estate working for you at scale if you start with the fourplex. You know, another indicator that one just needs to be bold in life is when I launched the Get Rich Education podcast. Clayton, I launched the show with a $60 USB microphone plugged into the side of an everyday Hewlett-Packard laptop on an Anchorage, Alaska dining room table 3 years ago. And 1 million downloads later, I knew that I was making an impact. And having Robert Kiyosaki on the show with me a number of times, I knew that I was having an impact. So it really just takes being bold. And you've got to ask yourself, do you want to have a life of oh wells, or do you want to have a life of what ifs? I think you'd rather have a life of oh wells, and you don't need to wonder what if.
Oh, I love that idea. So, you took action. So many people are just held back by taking action. You said, who cares? I'm going to get a $60 microphone. I have something to say. I want to share this with the world. I'm going to do it. I don't care that I don't have a ritzy big studio. I have a dining room table here in Anchorage, Alaska. I bet the bandwidth is even as good as maybe in the mainland. And you said, I don't care. I'm just going to do it.
Yeah, that's right. So, and I think part of financial betterment through real estate for a person begins with that mindset of being bold and transitioning that into realizing that in order to acquire wealth, you need to focus on increasing your income, not reducing your expenses. You know what? Don't build a budget. A budget is for penny pinchers. A budget says that you're trying to reduce your expenses. Well, guess what? You can only reduce your expenses so far. And when you do that, you're living worse anyway. Instead, build a cash flow statement. That's productive, okay? That's how you're increasing your passive income. You want to focus on production, not reduction, because you just cannot simply shrink your way to wealth. There's just simply no way to do that.
Yeah. Well, it's a really fascinating way of looking at it. Most people think that, get out of debt, right? It's sort of the Dave Ramsey approach, right? Just get out of debt and then you're going to be fine. But you're not actually producing assets. You're not building your net worth. You're not adding to your balance sheet. Let's talk a little bit about the balance sheet, why that's so important.
Yeah, well, the balance sheet's so important because you can see how your assets are growing kind of on that left side. So you have assets on the left, liabilities on the right, and you want to be able to track this. You need to know what your leverage ratio is. I'm a big proponent of borrowing, of using smart debt to get a great return. And I can give an example of leverage later on. But with your balance sheet, you can see the value of your assets on the left. And you can see, for example, your remaining mortgage balance on the right. And you can figure out just how much leverage you have, because getting your money to work for you will not create wealth. I'll say that again. Getting your own money to work for you will not create wealth. And that's a real epiphany for some people. So, that's the importance of that balance sheet, just seeing how you're using other people's money, the bank's money, to your financial betterment for your gain. So, really, Clayton, there are three classes of people in the world economically. There are poor people, there are middle-class people, and there are wealthy people. What do poor people do? They work for money and they don't have anything left over. And I'm not disparaging the person that picks up the garbage can on my wife and I's curb weekly, because I need those. They're a valuable person to society, but they don't have anything left over. Well, what do the middle class do? They work and they have a surplus. And what do they do with their surplus? They invest in things like stocks, bonds, and mutual funds. And you know what that middle class person thinks? I'm getting my money to work for me. What could possibly be better than getting my money to work really hard for me? Yeah, I've got it figured out. Well, no, the middle class do not have it figured out because they only have their money working for them. The thing that the wealthy people have figured out is the OPM. They've learned how to make other people's money work for them. And that's the abundant mindset shift. And now some people would say, using other people's money for your own wealth, is that legal? Is that even ethical? Yeah, I'd actually say it's both. It's highly ethical because you want to provide housing for people that's clean, safe, affordable, and functional. Do good in the world. When you invest in real estate with a loan on cash flowing property, you're actually using other people's money 3 ways at the same time. You're using the tenants for cash flow, you're using the banks for a loan and leverage, and finally, you're using the government's money for things like tax depreciation and a vehicle like a 1031 exchange. So you're actually using other people's money 3 ways at the same time. And the great news is this is available to absolutely anybody. Just like I said at the beginning of the show, you don't need to be the most intelligent or articulate or wealthy person. This is great news.
Right. Yeah, that's incredible. You and I talked before, the idea that, look, yes, there's many, many millionaires that have been created as a result of real estate investing, and many of them have never gone to college, right? Yeah. They don't have master's degrees.
It doesn't take any sort of formal education. In fact, it doesn't even take a certification. You don't even need to have something with a beautiful frilly border that you put up on the wall in order to be a successful real estate investor. So, it's really one of the last frontiers for someone that doesn't have a formal education to make terrific wealth. It can be done.
Let's talk a little bit about your experience with that four-plex. It didn't go exactly as you had planned, right? Because you were starting to deal with tenants at the time. Now, so you're living in one of these units, and then, as you put it, reality ensued. And what sort of unfolded with the tenants that you were allowing to stay in your property? You were managing it yourself.
Yes. A lot of times when you buy a four-plex building, you're going to inherit tenants that the previous ownership had. And in a sense, you think that you want that because that way you do have income streams on day one. That's the good news. But the bad news is you've inherited tenants that the previous owner has screened. And then you find out about all kinds of things. And tenants will push back against you right away. This is 15 years ago. I started quite young, and tenants wanted to see if they could get away with paying the rent late. And oftentimes they come up with a plausible story. Their mother was ill up in Fairbanks or something. So, okay, well, I'll let it float for 10 days. Don't do that. Nip that in the bud. They will take advantage of you. Okay. So when you serve them with that notice to quit, here's your line. The thing that you want to say when dealing with tenants and you need to serve them with a notice, here's what you say. You say, the law says that I have to. The law says that I have to go ahead and serve you with this document that says that the rent is late and you need to pay or you cannot stay. That way you're not the bad guy and they're not even the bad guy. You're just talking about the law. So that's a strategy to deal with rent that comes in late. But yeah, Clayton, I was a young guy. I made all kinds of mistakes. Like when I had a vacant unit next to me, finally, I filled it with a tenant, 3 tenants, because all 3 of them, and this is the only reason I rented to them, they were all attractive girls. That is the sole reason I rented to them. Well, you're not allowed to have pets, and they hit a dog on me, and it caused all kinds of problems. So it is a great way to start with a bang with a fourplex, but you will learn a number of life lessons.
Well, I think it's funny too that they thought that they could hide a dog from you. I mean, you're living in the same building in a fourplex. What, are they not going to take it out to go to the bathroom?
Yeah, dealing with tenants can make you lose faith in humanity is what I like to say sometimes. So, luckily for years, Clayton, what enabled me to get big and scale myself, after I had bought my second fourplex building and my wife and I had lived in a home about 5 miles away, and now I was managing 8 units from about 5 miles away. Was doing that for about a year. That was the point where I got a property manager. And the reason I didn't get a property manager sooner, I self-managed for 5.5 years, and it's one of my biggest regrets, is because I would go to my local real estate investor meeting, and a lot of those local real estate investor meetings have mom and pop landlords there. And you know what they would tell me, Clayton? They would say, Keith, you must manage your own property. You know why? Because no one's going to care for it as much as you. And for a while, I was nodding my head to that. But now that I outsourced management almost 10 years ago, I see that it didn't allow me to scale myself or get bigger sooner. So yes, no one's going to care for my property as much as me, but I'm not going to do it myself just to get that last 2% toward perfection. So go ahead and lean on your team, invest your time in finding a good manager, and then you can go on to a better and higher use.
No, I love that. So when you talk to real estate investors today, would you encourage them to hire the right property management team, get out of the way, create passive income? Or do you encourage people to get their hands dirty, be really hands-on with their, managing tenants, dealing with phone calls for leaky toilets and gutters that fallen down in a rainstorm? How do you handle it today?
You don't have to be hands-on from day one, but if you can self-manage your property for 1 to 2 years, it will help you. But you don't need to do it beyond 1 to 2 years, because in those 1 to 2 years, you will have learned a lot of the lessons that you want to learn. And I think the top lesson that you will learn is that you don't want to do it any longer. But down the road, if you do it yourself, that gives you a bit of an advantage, because you can better interpret your property manager statements from the various metro markets that you're invested in, because you had just a little bit of experience with it in the beginning. And that context is not absolutely mandatory, but it is valuable.
Good. Let's talk a little bit about the leverage, and then I want to get into some numbers. And then we're going to talk about how real estate investors actually get paid, which is something you're passionate about, because most people don't even know how real estate investors actually make money. But talk about like the leverage, and when you're acquiring properties today, what are you looking at doing? How are you buying properties?
I'm buying properties with 30-year fixed loans, and I don't try to accelerate the payoffs. I don't build equity in a property any faster than what I need to. So I actually keep my mortgage balances relatively high, so that way I can go ahead and buy more property. It's kind of the example of, would I want to have one $100,000 property completely paid off, or would I want to own 5 properties with 20% down payments on each of those 5 $100,000 properties? I want to keep my leverage ratio high, and I think you'll see why when we get into the numbers for how a real estate investor gets paid. I want to maximize that use of other people's money. When I have a loan with the bank, I get a return on both my skin in the game, my equity, and the amount that I have borrowed. So therefore, I like to plant small seeds in a number of properties. And additionally, this allows me to own more properties. So I'll just say, for example, I would rather own 40 properties than 5, because if I have 2 vacancies in a 5-unit portfolio, now I've got 40% vacancy. Or if I have 2 in a larger portfolio, it doesn't hurt me nearly as much. And the other thing, importantly, is when I own more properties, this allows me to diversify better geographically. This way, I can have properties in Alaska and in Texas and in Tennessee and in North Carolina, for example. So that way, I'm not subject to just one local economy's potential downfall. So when I own more properties with leverage, I can be better diversified. A huge mistake that real estate investors make is that they're only invested in their own home market. And that's a big mistake, because the market is actually more important than the property. For example, here in Anchorage, Alaska, at this time, our economy is down. We're in a recession. Rents are going down, which just blows away people that live in the other 49 states, because we're so dependent on the price of a barrel of oil. But because I leveraged myself, I'm able to own more property and own property in multiple states. And it just doesn't bring me down nearly as much as it would as what's happened with most of the people when they only invest in their own home market. So when your local economy goes down, the occupancy goes down, vacancies are up, appreciation is non-existent. In fact, my local properties have actually gone down in value in the last 5 years.
That's great. Let's talk about some of the numbers. And we're 2017, 2018 right now. Why do you think this is one of the best times to be a real estate investor? Or do you? I mean, are we seeing, that's the way I'm analyzing it, but I'd love to hear your take on what you're looking at with these numbers.
Yeah, well, this is a really good time to be a real estate investor. And that might be a funny thing to say, because the prices of most real estate is up in the last 5 years in most markets. And that is definitely a negative thing. But you've got to think, what's really better than real estate investing? And when we get into the numbers, you're going to understand where your return comes from. We still have mortgage interest rates that continue to flirt with historic lows that you can wrap up for 3 decades. We have more millennials that are entering prime renter age, and they are the largest generation. surpassing the baby boomers in size. And what do millennials have that prior generations didn't? Millennials have huge college costs. College costs have risen faster than inflation. That means millennials are saddled with this student loan debt. Well, they can't come up with a housing down payment. That's actually good for guys like you and I, Clayton, because a greater proportion of them must go rent. And that's why we're currently experiencing the lowest home ownership rate that we've had since 1965. And that trend is only expected to continue. So when people don't own their home, they have to be our renters, and that is really good for us.
I want to talk more about that in a moment, but first, tell me about the neighborhoods that you invest in. How would you describe the types of properties you buy, the types of tenants you have?
Yeah, I would describe the properties, and oftentimes it's single-family homes, and it's areas that are a little bit lower than average. I'd say between lower and middle class. Oftentimes they're Class C or high C. I've never owned A-class property. It's nearly always low B down to mid C-class property. And they're working class places. They're the sorts of places where when you drive through them at 11:30 in the afternoon, you don't see any cars in the driveway because everyone is at work. Mm-hmm. And that's where I want them to pay the rent. So they're working class. And I avoid words like luxurious and opulent. I might want luxurious and opulent in my own home, but that just doesn't make sense from a standpoint of rent income to purchase price. So I want to buy durable homes in neighborhoods where I can get pretty close such that 1 month's rent is about 1% of the purchase price. So for example, for a $120,000 home, if I can get close to $1,200 in monthly rent, well, that's a sign that that could very well be a profitable property. And I typically buy them turnkey so that they're already renovated so I don't have any maintenance and repair drag on my cash flow over time.
Why don't you like A-class properties?
Because we definitely have tenants that are rather finicky. We have a lot of little fixtures and things that could go wrong. But really the main thing from an investor standpoint is when you get to those higher end properties, when you get to properties above $200,000, $300,000, rent incomes do not keep up proportionally to those higher purchase prices. So in a lot of United States markets, if you buy a $500,000 home, you can't get anywhere near that 1% rent to value ratio. You can't get anywhere near that $5,000 rent income on a single family home. You might only get closer to $2,500. Well, there's a significant opportunity cost. If I have $500K worth of property, I want to go invest in a market where that can create $5,000 of monthly income for me. I want to go to markets where I can search for that 1% rent to value ratio. So we're talking about markets where the properties are generally low cost, but yet we do have job growth, and we are in areas where in-migration exceeds out-migration on a macro basis.
That's great. So 2018, great time to be a real estate investor right now. Where do you see things going over the next few years?
Over the next few years, I mean, that's always hard to say. I don't want to make any predictions, but there are just a lot of these macro things that make housing a sound investment. People need it. Clayton, some people just overlook the fact that places like Japan and Germany, they have population losses. Well, that creates excess housing capacity. Here in the United States, the population just continues to increase. So economics 101, supply-demand fundamentals, there is demand for housing, and that demand is not going to be soaked up anytime soon. We're kind of in the opposite condition in the United States that we were in 10 years ago. 10 years ago, we were in an overbuilt condition, but now for a lot of real estate types, we're in an underbuilt condition where builders are still needing to catch up, and we have this population growth at the same time.
Yeah, it's a great time right now. And you look at the data and you look at where construction permits are being pulled, and they're happening in A-class neighborhoods, high-rise apartments and big condo complexes and in metropolitan cities. But where you and I invest in these C-class neighborhoods, there's not a lot of building permits being pulled. There's not a lot of, huge apartment complexes being built. So guess what? That's great for you and me as single-family homeowners where people need to rent from.
Yeah, and that rental demand is still there. So we have the millennials really driving that demand. And, I talked about some of the demographic reasons for why that happened. There's really a psychographic component of why more millennials want to rent. Some of them still desire home ownership, but not at the same rate than they did previously. And that psychographic component with millennials, Clayton, see, millennials see what happened to their parents when millennials were growing up in their formative years. And they probably didn't understand very much about real estate. But if their mother and their father were underwater on their home, which a lot of people were 8 to 10 years ago, that child just knew in those formative years that the parents couldn't move because they were underwater on their home, or they might have seen them lose it to a foreclosure or a short sale. So that scarred millennials to a degree that they have some fear around owning their own real estate. And it's just a less desirable thing for them to want to do. And again, that is really good for people like you and I that want to build a cash flowing real estate portfolio with renters because we have a greater proportion of them now. And, another thing demographically, Clayton, is even if a population stays stable, think about what that population is doing if that's the same size, and think about how people live today as compared to how they did a generation ago. Today you have people living longer. Well, if the same population has people that are living longer, that's going to drive more demand for housing. And think, too, that people are postponing marriage until later than they used to. Well, if people postpone marriage until later than they used to, now we have two people that are living in two separate dwellings longer, whereas 30 years ago, they might have joined together into one housing unit 30 years ago. So two people might be living in two rather than two people living in one. So even in the same population, demand can be driven for rentership, even if there is no population increase, and yet it's increasing.
Right. And even we see the data among those young married couples are not even buying, and they're renting. So again, another reason for us to enjoy the realities of rental properties right now. I want to talk about how real estate investors actually make money. How do they actually get paid? And this is something you're passionate about. Walk us through why there's such ignorance on this issue.
There's ignorance because it's not that simple, but I think you're about to hear the simplest definition of how a real estate investor gets paid that you've ever heard. This is great news. And you know what? Most people don't understand how a real estate investor gets paid. They don't know how real estate's made more ordinary people wealthy than anything else. But you know what? Most real estate investors don't even know how they get paid. And it even goes further than that. Most real estate investing educators don't even understand how real estate investors get paid. Real estate is a 5-faceted asset class. So that actually means that you're paid 5 ways at the same time. In stocks, you're typically only paid one way. If you have a capital gain, maybe you've got a dividend paying stock, so you're paid a second way. But let's look at these 5 ways that you're paid as a real estate investor, okay? So let's say you've gone ahead and you've carefully purchased a $100,000 rental single-family home where the rent income exceeds the expenses. And yes, you can find these in the U.S. Midwest and South, renovated and tenanted. All right, so with a 20% down payment that you make on that property as an investor, that leaves you with an $80,000 loan. Okay, the first of 5 ways you're paid is with appreciation. In year 1, let's say your property appreciates from $100,000 up to $106,000. That is just commensurate with real estate's historic appreciation rate nationally of 6%. Well, 100 up to 106, that's not very thrilling, right? Well, not until you consider that your $6,000 gain, that's based on your down payment of just $20K. So that magic of leverage, $6K divided by $20K, that means your return is 30%, and that's one of only 5 ways that you're paid. The second way that you're paid is with cash flow. That's one thing that we're often after. Cash flow being your rent income minus all of the monthly expenses. And by the way, an easy way to remember your recurring monthly expenses after the mortgage is VIMTM, VIMTM, vacancy, insurance, maintenance, taxes, and management. So let's say your cash flow, income minus expenses on this property, is just $150, a pretty conservative number. That's $1,800 per year divided by your $20,000 down payment. That's another 9% return. And this 9%, that's what investors call the cash on cash return. So you now have a 30% return from appreciation plus 9 from cash flow. The third way that you're paid is with a tenant-made loan pay down. The tenant is eating away at that principal on your property. You actually don't have this advantage in your own home, in your primary residence, because you pay for that out of your pocket. So now if we just use a 5% interest rate on a 30-year plain vanilla loan, that's $1,176 that the tenant pays down for you annually in this first year. You divide that by your $20K of skin in the game, that is another return for you of 5%. So now we've got 30%, 9, and 5. The fourth way that you're paid is through tax benefits. We're talking about things like the mortgage interest deduction and something called depreciation that you can use as a write-off against your income. Depreciation, the short story on that, it means that you typically don't even pay tax on all of your rent income. We've got tax advantages like 1031s, where you can basically defer your taxes endlessly. This gets hard to measure, so let's just conservatively call this another 3% tailwind that you have. And then the fifth and final way that a real estate investor gets paid is one that so few understand, and that is your inflation hedging benefit. Even advanced investors fail to consider this. Okay, now, Clayton, just like you would not keep $80,000 in the bank over the long term because inflation would just erode the value of your lump of savings. It would diminish the purchasing power of your 80K. All right, well, in the opposite way, you have an $80,000 loan on this property. And see, that $80,000 loan, it has its drag diluted over time because over the years and the decades, more and more dollars circulate in an economy. Wages are higher, prices are higher, and rents are typically higher. And therefore, it just gets easier to pay that back. So if we just use a 5% rate of inflation, which is probably the real diminished purchasing power of the dollar, it's not the faulty CPI that the government reports, which is lower, which is a separate conversation unto itself. If you just call the true diminished purchasing power of the dollar 5% per annum, you've got an 80% loan. So we'll call that benefit another return of 4%. So when you add up the 5 ways you're paid, appreciation 30, cash flow at 9%, loan pay down 5%, tax benefit 3%, and an inflation hedging benefit of another 4%, you add that up, and your year one return from this income property is a whopping 51%. Now, for someone that comes from the consumer credit world, that just blows them away. They think that cannot be possible.
Yeah, what do you say to those people then? Because, listening to those numbers is just jaw-dropping. And when people come to work for us for the first time, they buy a property from us and they realize they're getting a net, 10, 12% return, cash on cash return year over year. They're just sort of blown away. They think this is risky. It sounds too good to be true. I hear that a lot. What do you say to those people?
Yeah. And first of all, let's note some limitations of my example. I didn't factor in any buyer mortgage loan closing costs, but the seller can often help you pay for those. We talk about strategies like that and at Get Rich Education. And if you buy your property in a losing job market or you hire the wrong property manager, then your entire investment could go south. But, I guess what I would say to these people that just think 51% is just incredible, that can't possibly be true. Well, I've just added it up for you. So, you can tell me where you think I'm wrong. And I'm right. I've been doing this for over 15 years. I think the one thing that I would remind newcomers with, Clayton, is a lot of these things are sort of phantom rates of return. They're sneaky. They're things that you're not thinking about, like the inflation, like that diminished purchasing power, therefore the diminished weight of your $80,000 loan over time. It's going to get easier to pay back. So I would just tell someone to open their mind and find out how to keep score. Basically, what we're talking about now is how to keep score in real estate investing. There's a lot of people out there that have invested in real estate and they are thinking that they're losing when they're actually winning. And there's other people that think they're winning, but they're actually losing because they just don't know how to keep score and they're not thinking about all these forces that are at work. So I think that's what I'd really say to that person. This is exactly why real estate has made more ordinary people wealthy than anything else. And a lot of people just don't understand it. And that's okay. I didn't understand it for a while either.
Right, exactly. You can't, you can lead a horse to water, but you cannot get them to drink on their own.
Right. Well, what if some things go wrong and you don't get a 51% rate of return? If 1/3 of things go wrong and, your return is written down to 34% in year one, well, you're probably still not going to be all that disappointed. So what else are you going to invest in that provides the type of returns and the 5 facets of income that real estate returns to you? And, another thing is it's really just the cash flow that you're feeling every month or every year. You don't get the full measure of some of these things like appreciation and an inflation hedging benefit until the longer term. So that's why a lot of these things aren't realized right away.
Right. Well, Keith, this has been a fantastic education. You can learn more about everything that Keith does over on his website. Tell us about where people can connect with you and learn more about everything you teach and all this great knowledge that you spew.
Well, it's at GetRichEducation.com and the Get Rich Education podcast, where we talk about how real estate's made more ordinary people wealthy than anything else. And we know how to keep score like I just described. You know what to optimize. You know what to minimize. You know which properties to get rid of. You know which properties to purchase. You know when it's ripe for doing a 1031 exchange or a cash out refinance. And you know what, Clayton? It really all comes down to this. You know, as investors, we have all these metrics and things. What's your cash on cash return? What's your internal rate of return? What's your cash flow? But you know what it all comes down to? Something that neither of us have ever seen on a Microsoft Excel spreadsheet. And that is, what is your ROTI? What is your return on time invested? When you can get a rate of return like this and you have a quality property manager that makes it passive, that's how you can build more wealth than anything else. So check us out at Get Rich Education. We regularly have Robert Kiyosaki and the Rich Dad Advisors on the Get Rich Education podcast, since I'm a columnist over there myself.
Wonderful. My guest has been Keith Weinhold. Thank you so much for joining us. Really been a great pleasure to have you here on the show.
Clayton, talking about this stuff fires me up, so thanks so much for having me.
Absolutely.
Yeah, I really love discussing real estate investing with the media like this. I'll be right back with more for you this week after a timeout. This is Get Rich Education Go.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president and chief wealth strategist of Valhalla Wealth. They help busy people build wealth outside of Wall Street by strategically combining their clients' cash flow statements with the financial vehicle of the wealthy, according to the infinite banking concept. If you are interested to learn how to perpetually multiply your wealth, you can access an exclusive webinar at yourownbankingsystem.com. Cash flow real estate investors, if you're looking for a mortgage loan with a company that specializes in investment property loans, it's Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. In fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. Get started at ridgelendinggroup.com.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
You know, and an interesting footnote, it was right around the time that we recorded that show that the interviewer there, Clayton, left Fox News, quit his day job, and quit the early morning wake-ups that he had to do for the Fox and Friends show in order to become a full-time real estate guy. So, I mean, that's just fantastic. And I really don't think that hearing about the 5 ways real estate investors are paid from me factored into his decision, but who knows? Now, a 3.5% down owner-occupied four-plex like I started out with, that does not work in most markets, because between the type of tenant that you can attract in a property like that, because a lot of these fourplexes are older, they just don't build those nearly as often as they used to. And then finding a fourplex that you would want to live in for 12 months yourself, because living in it for 12 months yourself, that is one requirement of that FHA 3.5% down payment program. And also note that a lot of markets, they just don't give you anywhere close to that 1% rent to value ratio, even when you start getting some economies of scale like you get in a fourplex. Now, notice that 51% return that I calculated on the show there from your first year in real estate investing this way, that does go down in future years. Why is that? Well, it's primarily because you accumulate more equity in the property. And as you know from listening here, since the return from equity is always zero, the heavier equity position, that just continues to dilute your return. And that is why you need to aggressively harvest your equity, just like you have to harvest corn or harvest grapes before those crops grow rotten. You need to harvest your equity in the same way before it makes your return rotten as well. In other words, that means that you need to pay attention to your velocity of money. How fast are you keeping it moving? And more equity, that adds friction to your velocity and slows you down. I'm going to do an upcoming episode where I discuss what's the best thing for you to do when you're carrying more equity, because we've all been experiencing appreciation these last few years. So what should you do? Should you do a cash out refinance, or should you do a 1031 tax deferred exchange, or should you even just do an outright sale of the property in order to get the equity out? What is the best way? We've also got shows coming up on what do you do if you get a low appraisal on a property, and how can you prevent a low appraisal from happening on a property anyway, or is there a way that you can prevent that, and why do low appraisals happen in the first place? We've also got Rich Dad Advisor Tom Wheelwright coming back soon for what I think is going to be his 10th appearance on the show here. I've kind of lost count by now, and we love Tom Wheelwright here, and so do you by judging from the feedback that we get. You know what? Out of 7.5 billion residents in the world, Tom is the only person I've ever known that can make reducing your taxes sound exciting. So now, today, you can invest in the same way I invest and with the same exact providers that I use, should you so choose. You know, anymore, you just really don't need to spend thousands of dollars or tens of thousands of dollars on some investment guru's program like you might have had to before. And really, there are 3 major actionable steps for you. And you've actually probably done the first one of those 3 already, and that is getting an education at GetRichEducation.com. You are doing that right now because this show that you're listening to is part of GetRichEducation.com. But if you haven't visited the site lately, we've got more videos than ever for you over there, where I appear in a lot of these quick 3-minute videos where I'm talking directly to you, and I just pick various important real estate investing topics and mistakes that you need to avoid. A lot of places charge for videos like that, but mine are all free, so you're already getting educated at GetRichEducation.com. The second step is finding out how much income property that you qualify for with a reputable mortgage lender that actually specializes in income property. We recommend ridgelendinggroup.com because they have, in fact, helped more people realize their dreams through real estate investing. Yes, investing, not primary residence loans, but investing in income property more than any other mortgage lender in the country. So once you've found out how many properties you qualify for with Ridge Lending Group or your other mortgage company of choice, then the last step for you is to go to GREturnkey.com, where you find the properties. GRE stands for Get Rich Education. At GREturnkey.com, that's where you can grab a report from a reputable provider in an investor advantage market or 2 or 3 over there. And that way you're going to have all their contact info so that you can ask them about available properties. And yeah, sometimes you do have to make a phone call because inventory is getting thin. Sometimes you need to make a phone call after you get that report because actually, just like I said in my interview there, 10 or 12 years ago, we were in a situation in the United States where we had an oversupply of housing. We were overbuilt, and now it's an undersupply. And actually, as new construction is taking place, they're really building like the more expensive stock where the numbers don't work anyway. So they're really not helping relieve supply for the demographic that we serve, which is typically just below middle income. So most of the homes are priced between $100,000 and $200,000 over there at GREturnkey.com. And note that I said most. At the low end, you might find income properties for as little as $80,000 or maybe even $70,000 there at our Memphis provider. And by the way, the Memphis provider's name is Mid-South Home Buyers. In Dallas, I think that's the only market where you'll see purchase prices exceed $200,000, although you might see that in Charlotte, North Carolina as well. But in any case, for those preferred providers at greturnkey.com, realize that it's going to take about 24% of the purchase price for you to close on an income property. So that's your 20% down payment on the property, plus about another 4% for your closing cost and prepaid escrow items. So there you go. That's $24,000 out of pocket on a $100,000 property, and that would be $48,000 on a $200,000 property. And, you're also going to want to hold on to some liquid reserve yourself, because in case you have an extended vacancy or a big repair expense, you're going to want to have some funds to fall back on. Now, I just don't want to see you be in a position where you have to liquidate a property. So that's part of the power of having the reserves. But remember, you're also going to have a landlord's insurance policy on the property, which is going to hedge your downside in case of a problem. And in fact, your lien holder, the bank, is going to require that you have an insurance policy. And I like seeing you hold at least 3 to 5% of the property value in liquid reserves. I mean, you're going to do whatever you're going to do. So if you own $1 million in property, then $30,000 to $50,000 or more is usually going to be adequate. And remember, your lien holder is usually going to require that you be able to show them some liquid reserve amount just in your loan qualification process anyway. And yes, gold and silver bullion, that counts toward your reserves. I mean, precious metals are some of the most liquid assets in the world. So yes, that counts, although your lender might not give you credit for that in your reserve requirement. If you have funds available in a home equity line of credit on your primary residence that you haven't drawn against in case you would have some emergency, well, that's really up to you as to whether you want to count that toward your liquid reserves or not. So that's it. For the loan, it's Ridge Lending Group. And for the properties, it's greturnkey.com. As always, thanks for being here, but you weren't here for me. You were here for you. So go out there, get a hold of multiple cash flowing income streams. Now, instead of following money, you've made money follow you, and don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Ranked by Forbes as one of the fastest growing cities, Orlando, Florida has a big and diverse economy, yet still features affordable rental properties that cash flow. Our boots on the ground turnkey provider, Greg Bond, wrote a special report to help you discover the amazing market of Orlando. Request your free copy today. Visit GetRichEducation.com/Orlando. That's GetRichEducation.com/Orlando.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.